My reasons for a bullish case for oil and gas prices for 2024. I'm Sean Pruitt, president of Kingdom Exploration. Now, inventories are low, spare capacity is low, and demand has hit record levels. And we just waged war on Yemen, which is Iran, proxies, with interest rate cuts. It's teeing up for the greatest year for the price of a barrel of crude. And I can't tell you how exciting it is to be alive and be in the oil business today, okay? And the reason why very few people are talking about this is simply because they've been beat up so bad over the last year, reducing their willingness to see the bullish case, or at least say it, okay? And so a lot of my notes come from analysts like Jeff Carey, geologists like Art Berman, and I have various sources that I research. Data is very hard to come by, but I keep up with the news over the last several years, and so I'm going to share my take on the future of oil for 2024, and I'm going to give you the highlights, and then I'm going to go into a little more detail as to why, with some great graphs and data from Art Berman. And so the reason for an increased output of oil, okay, oil output increased in 2023, and nobody expected it. We didn't expect to see an additional 3.4 million barrels of oil on the market in 2023, and I'm going to talk about that. So the Europeans quit spending on renewables and green investments and redirected that capex into the Gulf of Mexico. Okay, now that's not going to happen again. Okay, so that's a one-off. Okay, so 200,000 barrels of oil came from the Gulf of Mexico, 100,000 barrels of oil from the Permian, and 100,000 from Bakken. All right, so the Bakken can't be repeated. The Gulf of Mexico can't be repeated. The only one that could be repeated is the Permian, but you're fighting against the decline rates. I mean, the decline rates in the Permian are getting higher. And when I say decline, for every million barrels a day you produce, you got to find another 450,000 just to stay at a million output. Okay, so you're chasing after the wind. And so we had global synchronized disinflation throughout the entire world, okay? And it occurred against a backdrop of record commodity demand, okay? So normally when you go through this, you don't have record commodity demand, but we did, all right? So we were draining our reserves. And it occurred against the backdrop of a very strong U.S. and a relatively good China and global growth, okay? So demand oil was there. And so therefore, it cannot be demand-driven, all right? So demand was not the reason for the price of a barrel of crude and the effects on the market. It was supply-driven, all right? So you got to ask yourself, can monetary policy or physical policy create supply in 1 year's time? Because we had an increased amount of production in 2023. Okay, so it wasn't just simply because they spent money and drill baby drill. No, it had nothing to do with that. Well, it had some to do with it, but not near. So the only thing that you can do is regulatory easing. And where do they regulatory ease? The sanction on Venezuela, Iran, and Russia. Okay, that's number one. And then number two, environmental policies. And then three is on immigration policy. Okay, so you have energy. You have more energy, more food, and more labor, and that created the perfect situation for disinflation, worldwide disinflation, okay, which is why we could start easing rates so quickly, okay? None of them are repeatable next year, all right? And here's why, okay? And here's where the analysts got it wrong. Sanctions. All right, so they eased sanctions on Iran. Iran added an additional 800,000 barrels of oil a day. Venezuela, 150,000 barrels of oil, and 2 million barrels of oil from Russia. All of this was unexpected. That's 3 million barrels of oil out of the blue, okay? Similar to the record growth in U.S. shale back from 2012 to 2019. Nobody expected shale to grow so quickly. I'll give you a little more detail as to what I wanted to share with you guys and why I believe that 2024 is going to be an amazing year for oil. Right now, WTI crude is trading at $73 a barrel. Brent crude is $78.62. It touched a little over 80 today. And so WoodMac, global oil demand to rise by 2 million barrels a day in 2024. Okay. Oil demand will continue to set records this year with global demand growth expected at nearly 2 million barrels per day compared to 2023, Wood Mackenzie said in a report on Thursday. China will account for around 25% of the worldwide growth in oil demand, according to the energy consultancy. Total global oil demand will average 103.5 million barrels for 2024, Woodmac said. Now, the big news, and so here's the deal. Demand for oil, contrary to popular belief, the demand for oil continues to rise even during a recession, okay? And so we're coming out of recession. We are going to start cutting rates. What do you think is going to happen to demand? I mean, it's going to increase, all right? Naturally. Worldwide, it's going to increase, all right? And China's, China demand, if you look here, China's oil imports hit an annual record in 2023. And so China demand is increasing, okay? Now, I really want to talk about what's happening in Yemen. We just dropped bombs on Yemen in retaliation to the attacks of the ships in the Red Sea, okay? Now, here's a warning from Saudi Arabia. Well, I wouldn't say warning, but here's something that Saudi Arabia said. The foreign minister of Saudi Arabia regarding the strikes in Yemen, the kingdom is following with great concern the military operations in the Red Sea region and the raids on its sites in Yemen. We stress the importance of maintaining the security and stability of the Red Sea region and call for restraint and avoid escalation. And so here's the deal. The reason why Saudi Arabia is saying this is because the Houthi rebels, Iran, warned Saudi Arabia, if you open up your skies to America, okay, we are going to retaliate to Saudi Arabia. Now, so in order for America to drop these bombs precisely on Yemen, they had to use Saudi airspace, and Saudi Arabia opened it up. They did not heed the warning of Iran, of Houthi rebels. And so it behooves Iran, it behooves the Houthi rebels because they made a threat publicly. And so now they have to make good on that threat. Otherwise, they just look like liars and nobody respects. Because the thing that Iran and the Houthi rebels have going for them is that when they say they're going to do something, they do it. Okay. Now, here's why I believe, okay, that we can see the escalation tensions between Yemen, the Houthi rebels, and Saudi Arabia. Here's why. Number one, they warned Saudi Arabia publicly. And if they don't retaliate against Saudi Arabia for opening up their skies and working together with America to attack Yemen, they're going to look very bad. They have to retaliate because this is how you fight a war. You deal with this is a strategic way to keep control of that region. They have to attack Saudi Arabia. That's number one. Number two, it behooves Iran, the Houthi rebels, to attack Saudi key oil facilities. Here's why. Saudi Arabia enriches themselves from the sale of oil. Houthi rebels get their money from oil. Russia gets their money from oil. Hezbollah. This whole war, the only way Iran could maintain their status in the world, maintain this war, pay for the war, the only way Russia could pay for the Ukraine war is oil. The higher the price of the barrel of oil, the richer Iran becomes. One attack on a key oil facility will make them billions and billions of dollars. Okay? That's a very strong point. The other reason why I could foresee them attacking Saudi Arabia, especially key oil facilities, and it would be a slap to the face of the West. The West have done everything they can do to retaliate against OPEC, against Russia's, they call it the Putin price hike, against Saudi Arabia curbing oil production, Iran playing games, trying to choke off oil in the Middle East. The only way they can offset it is by using BlackRock, State Street, and Vanguard to try to control oil markets, and also using the media, trying to control the narrative. Because in the past, when Bush was in office and we started attacking Iraq and when we went to war with Libya, oil prices skyrocketed. I mean, a little bit of news. I mean, if you farted in the direction of the Middle East, oil prices skyrocketed. Now you could drop bombs in the Red Sea and oil prices go up $1, $2, but it doesn't go up $20, $30, 100% like they did in the past, okay? And so if you dropped a bomb in Iran, oil prices are going to skyrocket like you wouldn't believe, okay? And it's different now because America's at war with Yemen. America's at war with the Houthi rebels. America's at war with Iran, and it's only going to escalate. Iran, the Houthi rebels, they have already said we are going to retaliate against America. Okay. And so we're at war, guys, in the Red Sea, and it's only going to get worse. So this exasperates the price of a barrel of crude, and it puts tremendous upward pressure in the markets. You're going to see the markets agreeing with what I'm saying over the next several months here. Okay. And so tankers advised to stay away from Yemen as tensions rise. Okay. And so tankers travel with a tremendous amount of oil. If tankers cannot export the oil, then the oil can't get to the refineries and causing the price of a barrel of crude to go up, causing energy prices to go up. So that greatly affects the markets. Now, here's the biggest thing. Okay, I want to talk about. So this is Art Berman. He made this graph here. Okay, now I want to show you how the comparative inventory, the inventories, greatly affects the price of a barrel of crude. Okay, so if you look here, this is inventories. The lower these yellow bars go, the lower the inventories are. The higher these yellow bars are, the more inventories are increasing. So if you look at the price of a barrel of crude, it goes up when inventories go down, okay? And so if you look at when we were in a surplus, which was in January to April of 2023, we saw oil prices dropping. And then when inventories started to drop again, oil prices started to go up. So inventories has a tremendous bearing on the price of a barrel of crude. What I believe, the reason why these prices are greatly affected by the surplus and the deficit of crude oil in the stocks is simply because State Street, BlackRock, and Vanguard, and these large companies follow this, okay, more closely, okay? But it comes down to how much oil the Middle East and America has to produce, okay? If it was based on fundamentals, we'd be thinking about the lack of oil and gas development, the lack of the ability to duplicate what we've been able to do over the years, and the decline of shale, the decline throughout the world. And so they're not taking that into consideration. They're just looking at these numbers, even though that our inventory levels are the lowest they've ever been. It's kind of like, hey kids, we used to have $1 million in the bank, but now we have $10,000 in the bank. But guess what? I added $10,000. Now we have $20,000. So things are great, and that's what the markets are saying. I mean, we should have a lot more oil inventory, especially with record output, but we don't. And so that just means that demand is stripping the excess supply. But this is all going to bite our ass down the road. When supply drops, surplus drops, output drops, you're going to see, and then geopolitical storm is coming. I mean, the Middle East war is getting worse. It's going to be bad for people that are negatively impacted by high energy prices, okay? I'm going to go over an article by Art Berman, okay? It's called The Beginning of the End for the Permian. It's a great read, and I'm going to go over this article. And it's very important for you to understand this, because if you understand what I'm about to teach you right now, if you don't already know this, then you are going to, in the long haul, know for a fact that the price of a barrel of crude will go up, okay? It's inevitable, all right? You have to understand that this supply-driven market is about to take a turn tremendously. The Middle East wars are going to keep the price of a barrel of crude up, but at some point we need fundamental proof for higher prices because the market demands it. All right, and so the markets, once they see the decline of shale, the fundamentals will kick in, and it will be exasperated, multiplied by the Middle East tensions. Even if the Middle East, for whatever some miracle, we have peace in the Middle East, this fundamental truth at some point is it's gonna come home to roost. And so I'm gonna share some of this article. And so isn't the U.S. producing a record amount of oil? Yes, U.S. output increased by more than 1 million barrels per day in 2023 13.2 million, and about 80% of that increase was from tight oil plays. Okay. Tight oil is shale. Okay. This is what I'm going to focus on. Okay. Shale oil and gas, fast declining asset that is very expensive to produce. Okay. How can well performance be decreasing while production is increasing? Okay. The answer is that shale wells are producing at higher initial rates, but are declining faster than in previous years. Their total recoveries are lower than just a few years ago. The wells are burning out. Oil supply, lifelike, is a marathon, not a sprint. The plays have been over-drilled and wells are interfering, okay, meaning they're drilling too close to one another. They are cannibalizing production from each other. The Permian Basin accounted by 46% of U.S. domestic supply. Other tight oil plays were responsible for 22%. Conventional and offshore production accounted for 32% and has not increased for the last 15 years. Okay. So conventional oil has flatlined. It's not increasing. It's not decreasing. Okay. That makes it pretty clear that if shale production decreases, U.S. production decreases. The conventional base is only about 4 million barrels a day. That is the level toward which U.S. output trend. Okay. So look here. This is conventional oil in the dark orange here. Other tight oil is in orange, and the lighter orange is the Permian. Okay, so you can see here, shale increased while conventional oil stayed the same. Okay, so a decline in shale would mean a decline in output. Okay, now the Permian, Eagle Ford, and Bakken plays accounted for 93% of tight oil production in 2023. Okay, and so this is the focus. And so here's the Permian. Here's the Eagle Ford, and here's the Bakken. That accounted for 93% of the tight oil production in 2023. All right. So let's fast forward. Well, here's a good graph here I want to show you here. All right. So 2023 and 2022, Permian horizontal well initial rates lower than 2021 production levels are already lower than in 2021 because of higher decline rates. Okay. So if you look here in 2021, the output for shale averaged about 900 barrels of oil. 2023, red here, the initial outputs are lower than in 2021. Okay, so they're drilling wells, but they are having less output. Okay, and the decline rates for output is much faster. Okay, and so the production levels are already lower than in 2021 because of higher decline rates. All right. So the new wells that are being drilled are not as efficient. Well, they are efficient. It's just tier 2 assets. The quality of reservoirs, the quality of oil projects are declining. Okay. And so you're getting these lower initial outputs and faster decline rates. And so the additional oil that they added, the additional supply that they added to the markets, it's a flash in the pan. And so you're going to see fast declines in the future. And that's the whole point of that graph there. Okay. Now, 2/3 of the U.S. production is poised to decline during this decade, but the United States exported more than 1.5 billion barrels in 2023. That's 1.5 times the amount exported from 1920 through 1950, when the U.S. was by far the world's top oil producer, averaging 82% of total world output. That's because until 73, there was a prohibition policy to both limit production and exports in order to maintain spare capacity. Okay. And so that's why we were importing so much Saudi crude. We were printing money and we were importing oil, and we were raping Saudi oil, and we were maintaining our oil supply abundance. Okay. Well, now today we're exporting majority of our oil. It's really sad to see. We're draining our reserves, and the Middle East knows this. If they cut us off from oil, we're screwed. So what are we thinking? Figure 7 suggests that the United States is now following a policy to drain America first. I like what he said there, and it's true. The drain America first hockey stick. The U.S. crude oil exports averaged 91,000 barrels a day from 1920 through 2016. 2023 exports averaged 4.2 million barrels a day. So if you look here, the oil exports skyrocket. Okay, in U.S. percent of world production, nobody can compete with us, and then we quickly dropped. And so you see the exports increasing there. Okay. I have considerable respect for the Energy Information Administration's work, but its shale projections have consistently puzzled me. Okay. And I agree with what he's saying. It seems that the EIA includes probable and possible reserves as well as technically recoverable resources in its tight oil volumes. It does this without any consideration for its own oil price projections and implications for commercially producible oil. So if I'm looking at an oil deal, okay, I've been investing in oil since '94. Okay. And if you include probable and possible reserves as well as technically recoverable resources in its tight oil volumes, I would tell you to jump off a cliff. I wouldn't say, because you're trying to entice me with reserves that might not ever produce. I don't look at that. Okay. I want probable reserves. Okay. Possible reserves, sure. But I mean, the EIA is calculating this in as if it's a fact. It's not a fact. The oil's underneath the ground. If you can't get it out of the ground, there's no benefit to oil that's sitting in the ground. There could be a billion ounces of gold underneath the ground, but if you can't get it out of the ground, you're going to starve to death. Okay, and so they're calculating reserves that are impossible to produce. Okay, and so this is unfortunately encourages the popular belief that shale plays will last forever. The problem is that these plays are just like all others, except that they cost a lot more to drill and complete. They are fields. All fields decline, and so this is true because. How do people in the news understand this? They don't understand the oil and gas industry. And they have these experts come online and they read this information. And then you have these analysts that are in the know, but they're gun shy because they've been so beat up by the oil and gas industry. And a lot of these guys are hiding. Okay. So a lot of these analysts are going to come out of hiding. This is exciting for them. They see the price of a barrel of crude coming out. So Permian tight oil reserves are estimated at about 15 billion barrels of oil. Okay, that's similar to the reserves for the Prudhoe Bay. North America's largest field. Production peaked in 1987 at 1.7 million barrels a day and has declined to 200,000 barrels of oil in 2023. Prudhoe Bay is the largest field discovered in the United States. Production peaked at 1.7 million barrels a day in 1987 and has declined to 200,000 barrels of oil in 2023. So if you look here, 1987 peaked at 1.7 million barrels a day, and then in 2023 declined to 200,000 barrels of oil. Now, keep in mind, Prudhoe Bay was a conventional oil play. Back in the 80s, they didn't have fracking technology. So back then, declines were much slower, okay? But this just goes to show you, they couldn't keep production 1.7 million barrels for eternity. It eventually dropped, okay? And that's the problem with the EIA. They're expecting shale to just keep producing for much longer. In what parallel universe do shale plays get an EIA pass on the laws of Earth physics followed by Prudhoe Bay in order to produce near current levels until the middle of this century? So he's saying they're crazy. They're insane. And I agree with him 100%, and many others do. The signals are flashing yellow, if not red, about the future of tight oil production. My analysis is not an outlier. In May, Pioneer CEO Scott Sheffield said that the Permian output will peak in 5 to 6 years. In November, Continental Resources Chair Harold Hamm suggested that core areas of the Bakken play were reaching their peak and that deeper tough rock objectives would be needed to sustain production. Gohering and Roswig wrote in May that the Permian Basin was depleting faster than generally believed and thought output might peak in 2023. Okay, this is the beginning of the end for the Permian and other tight oil plays. There are decades of remaining production, but at lower rates. The data is clear. Wells are producing less in previous years. It does not take a degree in petroleum geology or engineering to understand what that means. The production peak may come in 2024 or several years later. The details do not interest me. A long-term decline in shale play oil production that accounts for almost 70% of U.S. supply requires our attention, and it may be a good thing for the environment and climate change, but it will also accelerate the trauma of society, which unprepared to live with less. Okay, and so to live with less, ultimately, the price of a barrel of crude is going to go up for multiple reasons. We didn't see the decline in oil output in 2023 because we didn't enforce sanctions on Russia. We didn't enforce sanctions on Iran, and we removed sanctions from Venezuela, adding an additional 3 million barrels of oil. The surprise output from America, a lot of it's not repeatable, and at some point, shale is going to start declining. When you see a decline, oil demand, record oil demand, in combination with the war in the Middle East escalating, I'm telling you right now, oil prices are going to go exasperate and go up to levels and that is going to be surprising. And then add in the fact that we're going to have rate cuts. It's only going to put even more upward pressure on the price of crude. And I think they're doing all this now because oil is low. I don't think they would have attacked Yemen hadn't oil prices been lower, so they thought they could afford this, okay? But they got to a place to where the Biden administration will not be voted in if they continue to ignore the Middle East, and they realize that America wants to retaliate, and they're more interested in getting voted back into office than they are with stability in the world. That's to stay in power is more important to them than anything else, okay? And so I guess that was more important to them than keeping the price of a barrel of crude low, okay? All right, guys, I'm Sean Pruitt, president of Kingdom Exploration. If you like this channel, please subscribe. Look in the description below if you're interested in learning more. There's a link in the description. You can fill out a form. If you'd like to chat with me, love to discuss the oil and gas industry, please give me a call. All right, guys, we'll talk soon. Thanks.